Brutal waterfallings are literally slaughtering the markets. Is this the long expected crash, or is it just a temporary panic? In a matter of 17 trading days, most of the world's indices have plummeted an insane 33%. This horror story also entails Thursday's record carnage in modern finance history of an 11% decline in a single day. The big question that everybody asks themselves is this an overreaction and a temporary buy the dip opportunity, or are we actually looking at the beginning of a long overdue bear market? This is what we will try to bring clarity to in this episode. Whether you have money on the market or not, I propose you watch this episode, as whatever lays ahead might very well have a strong impact on you both financially, socially and politically. This episode is, for obvious reasons, an extensive one, and one that has taken me a lot of time and focus to make. Therefore, for the sake of simplicity, it is structured into 4 parts. In the first part, we will look at historical behaviors at market tops to get a better understanding of what might be happening on the markets right now. In the second part, we'll look at the current technicals, the arguments supporting and negating a crash in the making. There are quite a number of them, but don't worry, they'll all be neatly summarized at the very end of this episode. In the third part, we'll discuss theories that relate to the coronavirus and the market situation, which may strongly impact the outcome. And in the fourth part, we'll sum it all up and present a concise conclusion. For the sake of simplicity and in order to not swap back and forth between too many charts, I will mainly focus on the Swedish OMXS30, which pretty much mirrors the leading American indices anyway. But on a quick note before we get started, do note that nothing in this video is financial advice. Anything I say is my own personal opinions only. Please do your own due diligence before any investments. Let's get down to business. Now, let us begin by zooming out and look at it all from a bird's eye perspective. From making some general historical comparisons is a good way to better understand where we are currently at and what is more likely to be expected. For the market is herd psychology expressed, especially during panics and euphorias. This is what panics look like when you draw them, and is pretty much how most historical recessions have begun. Compare this to how the US Nasdaq began its recession during the IT crash in 2000. An initial 40% decline before recovering almost 60% of the losses. Then came the real crash. Similarly was the 2007 peak, followed by a 25% initial decline, a quick 50% Fibonacci recovery, after which it suffered from its real plummet. During these temporary recoveries, experts and media tend to call for false alarm and encourage people not to panic and to get back to business as usual. One of the most famous cases was when Warren Buffett said to Bloomberg Television, "The worst of the crisis in Wall Street is over," upon which the market literally rolled over and died shortly thereafter. But if we look at these waterfalling movements from another perspective, we also see that we've had a few such events in the midst of strong bull runs. Some examples of this are the 30% decline in 2011, which was followed by a 106% increase in 2.5 years, the 24% decline in 1997, and the 40% panic in 1998, whereof the latter was immediately followed by a 16-month parabolic run of plus 210%, an index. And I'm sure too that the medias back then had their logical Armageddon reasons lined up for why everyone would go bankrupt within 10 days. For one thing I can assure you, and that is that the market sentiments at those two times were extremely negative, where people had buckled up and prepared for a freefall. Now, most crashes are normally preceded by technical warnings of some sort. The typical example of such warning is the distribution phase, which almost always precedes a markdown. A textbook distribution phase consists of 4 components. 1. A dominating sell-off volume candle, far heavier than the average candle. 2. Wild price fluctuations. 3. A preceding parabolic run. And 4. When prices begin to trade below the EMA 200 on the daily or the EMA 50 on the weekly. We see this behavior in pretty much any topping formation. And the ideal example of this is the Bitcoin top of 2017, which contained all of the distribution phase characteristics. Hence, anyone with even basic technical knowledge was generously given multiple warnings and indications that a top was reached. Do note, however, that a distribution phase doesn't need to contain all of these, for we are rarely spoiled with so many clues. The distribution in and on itself can rather be hidden in a single clue, such as the distribution phase of 2007, where the only giveaway was its single dire sell-off candle. Of course, these are very difficult to base decisions on, as they are often only obvious a few candles in, when you see that there are no other volume candles that compare in extensiveness, after which you'd probably be more inclined to look for buying opportunities rather than selling or shorting. When we look at the chart, the distribution phase for 2000 is very obvious with wild swings back and forth. Just look at the size of the monthly bars compared to any bar prior to it. Of course, we need to look at this on the logarithmic scale, since the naked bars on a linear scale automatically will be bigger the higher the overall prices are. For a 1% movement at an index that costs 10,000 is as big as a 10% movement at an index that trades at 1,000. It's irrelevant. Looking at the charts logarithmically is therefore not just a good way, but also a necessary way to come to our senses and see how bad any injury actually is by comparing it to historical percentage movements. Hence, with the logarithmic scale, we can see the relative moves, which is the only relevant way to determine whether a top and distribution are in the possible making. Not only are we experiencing a heavy candle in terms of sell-off volumes, we are currently in the midst of one of the bloodiest red candles in modern history. And we still have another 2 weeks to go. For if we look at the magnitude of individual heavy sell-off candles on the monthly chart, we've rarely experienced anything similar before. We would have to go back all the way to the dire sell-offs in 1987 and 1990. And what they have all in common is that they have either preceded or constituted a crash. This, of course, is very bearish, and unless this month's candle reverses, chances are that this is just the beginning of the end. Now, tops and bottoms are almost always preceded by euphoric and panicky movements respectively. We will find few historical exceptions to that rule. Again, this is all the results of market herd psychology, for we are not differently wired today than we were 100 years ago. That would be as absurd as claiming a cod or a cow to have different instincts today as opposed to a century ago. Let's now proceed by taking a closer look at the current technicals. First of all, prices are back where they bottomed out 4 years ago, in June 2016, when the market made a double bottom at 1240. That on its own, of course, means that the markets haven't moved at all in 4 years, which indeed is a sign of weakness. But what's even more worrying is that it is 20 years since we first reached this very level on the OMXS30. In that sense, excluding company dividends, nothing has really happened in 2 decades. And taking dividends in defense is a weak argument, as their payouts are roughly 4 to 5% annually, which in turn has been grossly watered out by heavy quantitative easing programs that have significantly decreased our spending power. Now, putting this bearish long-term aspect aside, my prime worry at the moment is how fast and dramatic this current plummet is. It's been nothing short of a brutal waterfalling. However panicky things may be at the moment, from a technical standpoint we still have an upwards trend in the making. A 33-year-old trend from what I can see, but one that probably extends longer back than that. Of course, that could change at any point, but rarely without a warning such as at least one clue for a distribution phase. Sure, we have traded in quite volatile sideways movements for 5 years now, but this is not what top formations look like. They're not flat and extended. No, they're hysterical and pointy. This, alongside the long-term upwards trend, is one of the technical arguments in favor for continued bullish times ahead. On the contrary, a valid question at hand is whether this half-year-long 38% move in late 2014 and early 2015 technically constitutes the parabolic final movement of a market cycle. In such case, it would be an anticlimactic and unsatisfactory one. On the other hand, the strongest formations are typically the blurrier or less obvious ones. In that case, our distribution phase is confirmed, for technically we have had a parabolic run followed by wild swings and price movements. If so, the shape of our distribution phase is that of one giant bear flag. Looking at the technical map at hand, despite having officially entered a recession, we are still trading within a long-term uptrend, however fragile it might be. Some argue that the cycle is not technically complete, as we have yet not seen a satisfactory fifth Elliott wave. This would eventually lead us to the parabolic run that typically precedes a crash. Technically, I support this thesis, and I will soon display the only way for us to find out whether we are in a major bear market or whether this is a temporary dip. Now, don't get me wrong, for I'm sure we have some volatile times ahead regardless, but just because we've waterfalled by 33% doesn't mean things will automatically continue to be nasty. In 1998, for example, most indices declined by 40% in a 3-month panic, after which they went parabolic. For that reason, there is cause to believe this could be similar, at least if the coronavirus proves to be an overreaction. Of course, it is still too early to know whether that's the case or not, but at least it's a perspective worth looking into. In the end, it all comes down to some key technicals. If March ends up a devastating month without any significant rebound and with heavy sell-off volumes, far more than the average monthly candle, we may have a distribution candle that signifies that financial institutions have begun to make their exit from the markets. For there is nothing at this moment, halfway into the month, that shows any signs of decreasing trading volumes. For that reason, we may safely conclude that we in fact do have a distribution candle in the making. That on its own is likely a very valuable clue for nasty times ahead. Prices may partly rebound initially, but in that case they would simply be dead cat bounces designed to lull unknowing retail investors into false security. The final hope slayer to any buy the dip enthusiast. However, we still do have some things going for us, for as long as we manage to stay above this very important key box of support, things are still within some sort of control. This box at around 1240 also aligns with the monthly EMA 200, the alpha of all moving averages. And it is this very area that will determine whether the near future will be sunny or stormy. It's the critical moment and the key thing that you should take away with you from this entire episode. This area is so important that I will stress it again. If we break below this area and stay below it, prepare for horror. However, if prices do manage to stay above and the coronavirus blows off fairly soon, we may be in for a wild ride to the upside. Now, historically, both the IT crash of 2000 and the housing bubble of 2008 ended when prices respectively tested the EMA 200 on the monthly. That is as far as my charts go. Both on the OMXS30 and the US Nasdaq, the prices failed to break through and stay below for any significant period of time, but rather quickly recovered and shot up again. The next time this happens, whether it is due now or later, I strongly doubt we will bounce back as quickly as we did in 2000 and 2008, when we were blessed enough to only suffer from short-term recessions. Now, quite the opposite rather. For if this 1240 region doesn't hold, you better pray to God and brace for impact, for things are likely to get really ugly, not just financially but also socially and politically. Unless this stops here, we are likely in for what's been long overdue, and I'm not talking about a recession, I'm talking about a depression. For if that level breaks, we are likely in for the worst time since World War II, where right is wrong and wrong is right. Maybe then will humanity finally wake up and begin to focus on what's relevant and bring balance, order and morals back. It will be the ultimate humbling experience, duly needed for both many nations and many individuals. Please watch the episode Partying Like a President in a 5-star presidential suite, where I in late November rented a presidential suite at the 5-star London Landmark Hotel, where I gathered near and dear ones to celebrate exactly these times ahead. I just didn't know at the time that the corona might be the trigger that set it all off. It's a short episode that explains in detail my reasoning for welcoming times like this with open arms. I will link to it at the end of this episode. Now, technically, not even the rebounds show any levels of strength. Quite the opposite. Each temporary increase in price is immediately being sold into. Yet, despite the panics going on, the overall sentiment amongst many so-called rational individuals right now is the same old story. Oh, buy the dip. I'm talking about the people busying themselves at mocking others who worry. We see it all over social media. I guess we will always see the cool and rational people who scoff at others. They were the people on Titanic who kicked around football-sized ice pieces on the deck whilst enjoying themselves. And bear in mind, just because the corona hasn't killed too many people yet doesn't mean it cannot get bigger and more serious from now on. For even Hitler and Stalin were babies too at some point. Neither did the Spanish flu kill 50 million people overnight. I'm not saying this will happen. I'm just saying it might be wise to proceed with caution and hope for the best but prepare for the worst. Otherwise, the joke will be on the cocky, vain and overly intelligent people who know everything. And with regards to buying the dip, this is a great idea for as long as prices continue upwards, but at some point they won't continue and prices will collapse. The rubber band we have stretched out over 11 years now is highly strong and the snap will eventually hurt. That of course doesn't mean it will snap off right now, but it can, and we must all be mentally prepared that it just might. For we've gotten what we've bargained for one too many times now. Each of the latest recessions have recovered much too quickly and much too much. The next time, expect again an overly optimistic market sentiment to present us contrary results. We've heard those very same rational voices as they yelled "buy the dip" during Bitcoin's crazy 2017 run. Now, most of them are the biggest net losers as price plummeted by 85% at most and still haven't recovered much. Prior to that, Bitcoin had historically recovered fairly quickly after each bearish cycle. This time, on the other hand, Bitcoin still hasn't recovered 3 years later, and it's because people expected a crazy run to continue after just a short rest. Just like people think markets will always bottom out quickly just to return up again. I beg to differ, and so does the market. For that's not how markets work, and I talk about these very topics at length in many of my episodes on this channel. For as long as people are enthusiastic and optimistic, that is the market sentiment being too positive, the next positive cycle will not initiate. For this reason, due to fundamental market psychology, the next crisis to hit us, whenever it may be, is likely to last for a long, long time. For the markets are wired to punish as many participants at any given time as much as possible. And this is embedded in a cyclical fashion too, with smaller cycles being part of bigger cycles, which in turn are part of even bigger cycles. Simple as that. And at some point those big cycles burst. According to modern Elliott wave theorists, We are at the end of a grand super cycle, one that has been formed since the 1700s and which is now at the end of its wave 5, right before it breaks. And according to them, once it pops, the largest economic recession in 3 centuries is to be expected. Again, it all comes down to this key area. If we do break through, we would technically have a new 6-year low. This, of course, is very bearish, and our realistic targets would be the 880 area, followed by the next support level at around 570. Although in this case, given the overall rotten state of the macroeconomy, backed up by a potential grand super cycle, I would not be surprised if we eventually were to test the bottom of the IT crash low of 2002 or even go lower. If so, expect this bear circus to last for at least a decade. Do keep in mind that the 1929 depression lasted for 26 years before it was back again on its previous highs. So to all self-deceiving buy the dippers out there, this time around it can prove to be the most expensive financial mistake of your life. Just saying. Looking at the RSI, some people may have noticed that there is a clear bearish RSI divergence on the monthly. However, this piece of information on its own is irrelevant. This is because most new highs that actually do continue higher do have a divergence. Like in 1998 on the weekly, where the new top before going really bananas was a divergence. If this were not to be the case, it would be practically impossible for any equity to go parabolic, as the RSI otherwise would reach and exceed a value of 100, which would then be outside of the scale. So a divergence on its own is irrelevant. It needs to be combined with other technicals with which it can confirm a likely reversal. Breaking below and staying below the 1240 area, for example. What rather worries me more in terms of the RSI is that it shows clear tendencies of having entered the bearish channel. If the RSI were to reach the lower blue RSI line, the bearish confirmation, that would be another argument in favor for a long-term crash. Another thing that favors a possible collapse is the very fact that we've had a false outbreak from this 5-year-long huge ascending triangle. And as discussed in episode 8 from January this year, How to Beat Technical Analysis in 2020, we know that going in the opposite direction of a false outbreak is often a good swing trade to take, as prices tend to catapult from that momentum. I have a hard time seeing the markets recovering and making new tops in a foreseeable future. The best short to mid-term scenario from a probability perspective is some extreme sideways movements. As wild as things may be ahead, I still expect there to be some significant support at around 1240, as this support should be extensive. And if we manage to stay above this area for long enough for the corona hysteria to blow over, we actually do stand a good chance technically for a wild ride to the north. However, if that doesn't happen soon, as within 2 to 3 months, the heavy sell-offs and volatility we're currently facing after an all-time high would not be a sign of health at all, but rather a confirmation of a distribution. For unless we stay above this area and the corona blows over soon, I see no technical possibilities to prevent this Titanic from sinking. And if it does, God have mercy on us, for we're going 4,000 meters deep. Before moving on to market and corona related theories, if you feel this episode has helped you better understand the situation at hand, please help the channel by hitting the like or subscribe button, as it will make the content more visible to others who might benefit from it too. I make these videos in my own time and pay for them out of my own pocket in order to help you, dear viewer. They take a lot of time to make, and without your kind support the channel cannot exist. Now, a good old poker friend of mine and now trader colleague presented a theory 2 weeks ago, long before I had heard it anywhere else. He said that the markets, for obvious reasons, are very bearish short term due to the coronavirus, but that they in the long run should be very bullish from a fundamental point of view. For assuming that the virus will blow over in a few months' time, we will of course be short of a few months' worth of production. But looking at it from a longer time frame, the crass result of the virus from a market perspective is that it will primarily kill off old and weak people, as in the weakest links who do not supply value to society but rather end up as net expenses. Of course, this may sound like a psychopathic argument, but don't forget that the markets don't give a flying F about our well-being, neither on a personal nor a collective level. The market is the heartless psychopath that looks only at production, numbers, and net profits. Hence, if nature itself releases the old and the weak, that money can be spent on more productivity and more expenditures to keep the financial wheels rolling. Now, let me underline again that this is nothing that I or anybody else in their right minds wish for. I am talking about this solely from a macroeconomical point of view, what the practical results may be if the corona were to go away soon enough. Now, intellectually, I think he is absolutely right about his theory, and under normal circumstances, I would expect it to play out as a huge bull run, just as mentioned. Although, given how rotten the world economy is to begin with, the coronavirus could very well be the straw that breaks the camel's back. Also, whenever the markets face euphorias and panics, fundamentals fly out the window. Hence, if this panic goes on for too long, those fundamentals will be invalidated. In that case, it doesn't really matter how many good news we begin to outline, for they will have little to non-practical effect anyway. I still don't outrule a heavy last breath in terms of a significant parabolic wave 5. It just looks unlikely. But most importantly, for that to stand a snowball's chance in hell of happening, the support area at around 1240 must hold. I guess we just have to wait and see. Johnny Tercel talks about this phenomena in his book, with the Swedish title translated being Technical Analysis with Johnny Tercel, where he talks about 2 times when there were electricity power failures in the US in the 70s. On the first occasion, it was in the midst of a bull run. People stayed at home, lit candles, and spent time with each other. The second time, on the other hand, happened during a bear market. This time around, people did not cozy up. Instead, there were riots in the street and turmoil. Looking at the coronavirus chart, again from a logarithmic point of view, we see that it actually did stagnate for some time, but now it's begun to go nuts again. And when things go parabolic on a logarithmic scale, things are really bad. The big question remains, for how long will this continue, and what will the final damage be? How much will it cost us in terms of spoiled productivity, deaths, and what political and societal tensions will it worsen during its run? But here's the thing, don't for a second think the coronavirus is the sole reason for the current 33% market declines. It is simply the final straw in a very much unhealthy economy. I will discuss this very interesting and relevant topic at length in a soon-to-come episode. Now, don't get me wrong. The markets would surely have reacted very negatively even if the economy were to be fundamentally solid. But compare this to any globally impacting terrorist attacks, wars, etc., where prices reacted temporarily just to continue up and ahead shortly thereafter. Now, why is this different to other global threats? I'll tell you why. Because the global economy has cancer, AIDS, and the Black Plague, and all at the same time. In this case, the global economy is rotten from the inside and out. It has particularly worsened in the last 10 years due to irresponsible QE programs where politicians and central banks have kicked the can down the road rather than dealing with the situation in a grown-up and responsible fashion. For it sure is convenient for the reckless politicians and bankers who have fucked up the world economy and political climate to be able to blame the corona for all that's coming. It's the perfect scapegoat, for it's one that cannot defend itself. But whatever lies ahead should have happened already. In The Guardian, journalist Jurgen Lurendik's book Swimming with Sharks, he interviewed about 200 anonymous London bankers who claimed that the common public had no idea how close the world was to a financial meltdown in 2008. Finances were horrible already back then. A quick comparison would be the fact that George W. Bush borrowed as much money as all presidents before him had borrowed combined. Then came Obama, who borrowed as much money as all presidents before him, including Bush. America is the most indebted country in the history of the world, and they are the leading economical superpower. Whatever happens there will have huge effects on the rest of the world. And do keep in mind that most Western countries in turn suffer from unsustainable record-level debts. Just look at Greece, Italy, Spain, Ireland, etc. Just because they haven't made too many front pages in the last few years doesn't mean anything has changed significantly for the better. Quite the opposite. Since the last crisis in 2007, financial and political tensions have steadily built up to the point where it's no longer a question of if, but rather a question of when a bloodbath will take place, both socially, politically, and financially. I personally have been talking about this to my near and dear ones for 3 years now, hence these current events don't surprise me at all. In fact, I'm certain things will just get worse from now. For when we open up the hood of our shining global economy, we quickly realize that there is no engine inside. It's rather an empty pit full of IOUs. For that reason, I remain skeptical as to whether the global economy actually will make its parabolic wave 5, for I believe there is a good chance all the hot air will have escaped the balloon by the time the corona has blown over, to the point where no good news in the world will have any significant impact on the economy at all. To sum it all up, things do look dark. We are in the making of a distribution candle on the monthly, which typically signifies difficult times ahead. The current bearish momentum is nothing short of brutal, and the RSI shows tendencies of entering the bearish channel on the monthly. But there is still hope, for as long as we can stay above the previous support zone at 1240, which also aligns with the EMA 200, the strongest of the strongest EMAs, there is hope that this can be turned around for now. In that case, given that the coronavirus does come to an end soon, a significant parabolic wave 5 is still in play. If we do break below the critical zone at 1240 on the other hand, we are likely to enter not a recession but a financial depression. One that is likely to be the worst thing you and I have ever come to experience on a collective level. For at one point or another, the insane debt that our entire economy rests upon must at some point be paid back. Now might very well be the time. If not, it'll be postponed by another few years. In that case, whatever horrors lay ahead will be even worse. Please feel free to look into any other of my content on this channel, as it is full of market psychology and other content that may improve your investment and trading understanding. And please don't forget to like and subscribe. That was all for now. Goodbye.